Richard Hodges, thank you so much for joining us here at the PLSA Investment Conference. There's been a lot of conversation about these tricky geopolitical times. How on earth does this industry navigate them?
Well, I think the industry navigates these through the challenges that are ahead of us. Our investment strategies are all based currently off of the next event, whether it be political or whether it be a financial event. What we are all trying to do is generate a return where it's generally perceived at this stage in the cycle, very late in the cycle, and perceived to be the probability of generating significant returns in the future probably less than we've experienced to date. Then it's all about trying to generate returns up until event. But it's also the ability to look through and see how asset classes will perform post an event. That is where you're really going to look to generate returns in the future.
So in that environment, low yield, low interest rates, what do investors need to be able to do?
Well, essentially what's been going on over the course of the last couple of years, and certainly since 2008, we see spikes in volatility, we see spikes of concerns, and generically all investors have been doing exactly the same sort of transaction. You know, we've all been searching for income, we've all been searching for a yield and capital returns in an environment where we've had a suppression of income. We cannot in isolation generate returns out of income alone. So what we're all doing is waiting for spikes in volatility. This is represented as weakness in capital markets, whether it be equity or subordinated levels of of bank debt. We're all waiting for this move higher in volatility, a move lower in price, and then so we can capture these returns out of capital, because it is very difficult in isolation to capture returns out of income and income alone.
It sounds from what you're describing there that you need to be nimble, is the word I'd use. Is that a characteristic you'd look for? Yeah,
very much so. I mean, I used to believe in having diversified portfolio of investments to generate consistent returns. Over the course of the last couple of years, I've come to realise it's not a question of having a diversified portfolio. It's having a diversified opportunity set, but having concentrated investments in different opportunity sets. But really, it's all about generating capital. If I perceive that the capital opportunity is not available in an asset class, then I don't see the reason why you should invest in that asset class, unless there's a change in expectations that would mean that the probability of generating capital return is greater today than it was yesterday.
That's being willing to stand out, if you like. I know you've talked about herd investment. What do you mean by that, and what are you avoiding?
All you have to do is have a look at a chart of equity market volatility. If we go step back over the course of the last decade, and principally since Lehman's defaulted in 2008 and the resulting collapse that we saw in asset classes, you know, the volatility spike we saw lasted for about 12 months. Then you move ahead into 2011, and we had issues with periphery capital markets. You know, we were looking at South periphery economies relative to Northern core Europe economies, and we saw a spike in volatility that lasted 9 months. Then 2013, we had the Federal Reserve, the taper tantrum, and again another bout of volatility over periphery economies. Then we move forward to 2015. And what do we have in 2015? Again, we had Greece. Now, this lasted 2 months. Post that Greece event, we've seen significant rally in capital markets and indeed equity markets. And then we come all the way forward to 2016. You know, the sell-off that we had in equity markets and in risk products lasted 5 weeks. Then you come in again into 2016, that sell-off. Then you had the Brexit, that lasted about 5 days. Then you come into Trump, that lasted 5 hours, the volatility spike, and then you come into the last Italian referendum, and that lasted 2 hours of volatility.
It's exhausting.
We can only capture returns out of spikes in volatility because we cannot capture sufficient returns out of investing for income and income alone. And so you have to be nimble, you have to take advantage of these spikes in volatility. But one of the trends that we have seen is that the volatility spikes are getting lower and they're getting shorter. So the window of opportunity for investing and generating returns is also getting lower and it's getting shorter. The longer that volatility remains at these suppressed levels, and they're suppressed for a reason. I mean, you've got quantitative easing from the ECB, it's suppressed for a reason. the opportunity is getting less. So we have to jump onto these opportunities as we can.
So in that environment, who are the people that are winning?
The winners are the people that actually preempt a lot of these changes in expectations or these events and actually take advantage. But you can't wait until after the event to take advantage and to generate a capital return out of that small, be it increase in volatility and uncertainty. A good example will be France. We've seen a significant underperformance of French assets, French government bonds, ahead of the imminent elections that are coming up. The smart move, will I suggest, it's relatively immaterial what the result will be. It'll be, the smart move will be to investing ahead of this event, regardless of what the outcome of that event is. Because when an uncertainty becomes a certainty, then essentially we are paid to take that risk post. You're either going to buy a more expensive asset, or you're going to, we're all looking to buy a cheaper asset. Well, I would argue the smart move would be, and the way to generate returns will be, investing ahead of these events, whether they're political or financial, because everybody else will be looking to generate a return post the event.
So how do you become one of those preemptive investors? You have to have good geographic positions and good knowledges across different cultures, different geographies. You mentioned emerging markets to me earlier.
Well, first and foremost, I think the basic premise is you should be owning a put. What I mean is you're owning a put to protect yourself against sudden, sharp changes in asset classes, in prices, in performance. One of the reasons I perceive that equity markets are where they are today is generically we all own the put. We all are uncertain about the political events that are ahead in the future and uncertain about the economic events. We're discussing reflation relative to stagflation. So first and foremost, I think we all own a put. When you own a put, your ability to invest again in an asset class that's fallen is significantly easier. If you own an asset at 100 and that asset falls to 90, you want to be able to buy that asset again. If that asset falls to 80, if you liked it at 100 and you liked it at 90, you should be buying a lot of it at 80. With the ability of owning a put, it gives you the ability also to buy that asset at 100 and buy it again at 80.
So the courage of your convictions, if you like.
Very much so. It is the courage of your convictions. But I would prefer to own a put, understanding the cost of which I'm willing to give up to protect or immunize, not totally immunize your investment, but it's all about the ability to buy that asset at 80 after it's fallen 20%.
So we've got something like 900 pension professionals here at the conference. What do you hope you'll glean and what do you hope they take away from conversations they have with you today?
Well, I think the most important thing is for investors to understand potentially where you're looking to generate returns from. We all have our views on the economic outlook. We all have our views, and we're all debating currently about the move in interest rates from the Federal Reserve and any the knock-on consequences of the Federal Reserve changing interest rates in March, which is now priced in an 80 to 90% certainty. So I think it's one of the things is the delegates here, their ability to understand what they're investing in first and foremost. It's also the ability for them to understand on where they're looking to generate that capital, that source of capital return from. And it's through an event like this that delegates have the ability to meet firsthand some of the investors, the idea generators, not just the idea of how you're generating capital, but also where you're going to generate the capital in the future. That is the most important reason why investors should attend conferences such as this.
Thank you so much for sharing your ideas with us today, Richard. Thanks for joining us.
Thank you.